What's going on, everyone? Welcome to the channel. In today's video we're going to be discussing how to get started in the stock market. So I've broken up this video into 4 key points. The first one being how to put yourself in a financial position to start investing. The second is a brief overview of what the stock market is. Thirdly, having the right mindset to make profitable investments. And the final point is bringing everything together and giving you a step-by-step demonstration on how you can use a brokerage website to purchase shares within a company on the stock market. To cover my first point, putting yourself in a financial position where you are able to invest in the stock market. What I mean by that is the money that you put in the stock market has to be funds that you don't require immediately. So if you invest within a company, you buy some shares, say of Facebook or Google, you can't require that money immediately to buy things like your groceries, put gas in your car, pay for rent, because the way you make money within investing in shares is through the value of the share slowly growing over time. For example, if the price of a stock in 2020 is valued at $100 and you put $1,000 into that company, after a year, it goes from a value of $100 to $200. That $1,000 investment will double as the stock price has doubled, but that takes time to occur. It's not really something that happens immediately, at least for the type of investing that I find profitable and I think is safe for people to learn. For example, if you had to take out that $1,000 investment within the first couple weeks or month or anything like that, you have to take it out quickly without leaving it in for a long period of time, you automatically would have lost or not being able to gain that same return because you had to take your money out. You weren't able to keep it in there and let it grow over time. So that's why it's very necessary for you to not have to access those funds that you put in within the stock market. Just to illustrate my point, I've brought up the stock chart for Apple. Now, as you can see, in late June of 2019, the value of the share is roughly $200, and then over time up until now, the 31st of July 2020, the price of the company is $425 a share. As you can see here, the growth of a share is not always linear. There are peaks and valleys along the road, but you can see the earlier you take your money out, the less profit you would make from your investment. Of course, there are dips, there are periods where your investment will lose value. However, if you don't need the money immediately, it doesn't matter what happens in the short term with the price of a share. As long as you keep it in for say 5 to 10 years or longer, these small changes don't really matter, and it's about the long-term growth of the share price that is really what counts. Moving on to my second point, what is the stock market? Basically, the stock market is just the area where companies can give a part of their business. They can offer it to people to buy as a share. And the reason they do this is because when you offer shares for purchase, it allows the company to raise the amount of capital or the funds that it has, which it can then use to grow its business. There are different types of stock markets that vary between country. Say, for example, in America, you have the obviously companies like Facebook, Google, McDonald's, and then there's also different companies for Europe, Australia, New Zealand, and they all have their own individual types of companies that can be bought or sold. Now, you can trade stocks in between countries. You don't have to be living in America to buy American stocks or living in Australia to buy Australian stocks. There are brokerage websites which allow you to purchase stocks internationally. So when people buy shares within a company, they automatically become a part owner within that business. I'm not an owner in the sense that you're the CEO hiring and firing people or making business decisions when a new product will be launched, but in the sense that you now participate in all the wins and losses that that business undergoes. If the stock price soars exponentially and goes up in value over the year, you will be a part of that profit and your investment will make you money. However, if the stock price drops and there's a terrible year and a lot of bad decisions are made on the company's part, therefore you will also lose money as your share price drops. One of the best and consistent ways to make money in the stock market is through a long-term perspective of thinking to yourself, when you buy a share, there's a minimum time of holding it for a period of 5 to 10 years. Thinking to yourself, I've got a couple of grand, I'll put it in the stock market, I'll make a quick buck, see how much money I can make in a week. It can be quite a challenging way to look at making money through shares. It's a bit like gambling on a casino. It's not a very consistent thing you can do, and it's difficult to manage your cash flow when you look at it with this type of lens. The reason a long-term perspective is beneficial is because it stops you from investing emotionally. Now, your emotions can easily cloud your judgment and cause you to make bad investments. For example, people buying or selling shares because the stock price is going up or it's going down, favoring companies that they think are good or will make money, but not putting really any time into looking into them and educating themselves on the business, potentially ignoring things that would show that the company is a bad investment, or just buying a stock because other people are buying it without having really no knowledge about the business or the sector that it's in. And then when the stock price plummets or it drops or something odd happens, they don't know enough about their company to determine if it is something that will pass or if it is a legitimate concern where they should sell their shares. It can be challenging investing in the market for profit if you don't leave your money within the stock long enough for the price of the share to go up and to make a profit. And this can quite often occur when you invest with emotion, and short-term changes sway your opinion on what shares you buy. Now, to bring everything together, I'll give you a step-by-step demonstration on what it would look like to buy some shares within a company using a brokerage website called Sharesies. Sharesies is specific to New Zealand and it allows you to invest within the NZX, the New Zealand stock market. However, if you're overseas in a different country, a great way to get started investing in the stock market is by using your local bank to set up a trading account for you. In New Zealand, most banks offer this type of service, and in Australia it's the same. Highly recommend going to your local bank in whatever country you're in and talking to them about it and seeing if they can set up a brokerage account for you. This looks like when you're buying shares through a bank. Now, the example I have here is ASB, and the currency rate is in New Zealand dollars. But just to take a look at it, so if you're investing 1,000 New Zealand dollars, the fee is $15 to buy and to sell the share. So you have to pay a fee of $15 when you're buying the share and a fee of $15 when you're selling. So automatically, anything up to $1,000, there is a $30 fee for making that investment, essentially. And as you can see here, it's $30 for anything over $1,000 and up to $10,000. What I like to do with my investments is you want your brokerage fee ideally to be as low as possible, say something around 1%. So if it's $30 for anything over $1,000, you want to have your minimum investment be $3,000. Now, I know this might sound like a lot if you don't really have any savings available, but it is much more worthwhile to just make larger lump sum investments as opposed to making small contributions to the companies you want to buy, because you're constantly paying brokerage fees all the time. Now, you don't have to go as high as $10,000 to get the 0.3% buy-in, but it is something to factor in the brokerage fee when you're buying shares. I've brought up the brokerage website called Sharesies. This brokerage website is specific to New Zealand. However, in all countries, banks are the most common and easy to access brokerage source for people. The type of individual websites or apps you can use to buy shares varies. For example, in Australia, there is CommSec as a popular trading app. But as I said, the easiest way, try and go with your bank to get started on your stock market journey. Brokerage websites look quite similar, so if you're able to follow this demonstration, you'll be able to follow it on whatever brokerage website that you're currently using. All you would do to make a purchase in a share, you would go to invest, head over to companies, and then it'll give you a list of different types of companies that you can invest in. For argument's sake, I'll go with Air New Zealand. So it'll tell you the stock price, a bit of a blurb about what the company is about, and then a stock chart detailing how that company has gone. As you scroll down, you can see the fees for the company. So anything up to $3,000 is a 0.5% fee, and then anything above $3,000 is 0.1. All you would do is click on invest, and then it'll give you an option of either a market buy or a limit buy. But the difference between these is market buy is buying the share of the company at the set price. So for Air New Zealand, that would be roughly $1.30, and then you'd write the amount that you want to invest. Currently, I don't have any funds in my wallet. The order wouldn't get placed, but all you would do is top up your wallet to the amount you want to invest and then press invest now. What that will do is it'll place the order for those shares to be purchased. However, this takes time, normally a few hours, and it also only placed when the stock market is open. Now this varies from country to country, so I would recommend looking into the time zones and when the stock market is open if you're investing overseas. The other option that we have is limit buy. The difference with this is you can set the amount that you would like to pay for the share. So if you don't want to pay that $1.30, you might just write in $1 for the highest amount you'll pay, and then again putting in the amount that you would like to invest. What this will do is the share will only be purchased once the stock price drops to that amount that you've put in for your highest buy price. It won't buy at say $1.10 or $1.20. It has to be exactly $1 or whatever amount you decide is the amount that you would like to pay for that share. It'll prevent you from constantly having to check the stock price, say on Google or brokerage websites. Instead, you can just put in the amount you want to pay and forget about it, and then if that price does drop that low, it'll automatically be purchased. That wraps it up for the video. I hope you found the content useful. If you'd like to see more future beginner-friendly investing related videos, feel free to subscribe to the channel, and thanks for watching.